Today we'll be focusing on topic A. It's quite small. We'll finish it by today. It's just theory, and then we'll start with the calculations by next week. Next week Wednesday. Next week Wednesday. Yes.
Sorry, can I ask a question? So how many units are we going to do in the session? Are we doing, because there's like 7.
All right. I think it is 17. It is 17 learning units. The reality is we're going to try to move as fast as we can. However, that doesn't actually stop you from asking questions. And I'm going to give you my number, which is a WhatsApp. I suggest that we create a WhatsApp group. So for any questions that you guys have, you can actually send it via the WhatsApp. You can send it via the email. Okay. However, I cannot promise you to respond back to you immediately, or I cannot respond to you. Please, guys, I'm going to ask you to actually respect my timeline. I'm going to ask you guys not to send me any, or do not expect me to respond or participate in the group after 8 o'clock. Right, to my knowledge, we've got 5 topics. It's ranging from A up until E. Right, so it's going to get quite stupid when we do topic B, C, and D. Right, so the tricky part about you guys, I'm not sure, but I think it's still continuing. You guys are actually doing your multiple choice. You don't write. You don't write where we actually mark you on the stripes or the principles. We mark you basically on the final answer. Okay. So I think the mistake that I did before, especially the last semester, so I didn't know that I'm allowed to give my students my personal number, so that I was advised by my line managers that no, actually you should go ahead by doing that, and then you can be able to communicate with your students via the WhatsApp. Usually I used to give out my email, even though students were actually sending out an email, and I would reply as usual. But at the end of the session today, I will be able to give you my numbers, and then you guys we can form a WhatsApp group, and it will strictly be about the content, nothing else. Okay, should I start the train or the flight? All right, I hope everybody's listening, as you can hear me clearly, but I know my volume on my side here, I don't know what is actually going on, but it's a bit slow. Sorry, it's a bit low. All right. But welcome to the FAC1502. It's a financial accounting. This is actually a reporting. Okay, so it sounds like somebody wants to speak. All right, if you've got a question, you can raise your hand. I'll be able to recognize you. Or you can just say, I don't understand this and this and this, and I will be able to give you feedback if I do have the answer immediately, based on what you're raising as a question. Right, as we all know, it's FAC1502, financial accounting. It's very interesting. It's actually reporting. Okay, so the entire content will be based on we upgrade our theory towards our financial statements. All right, so the financial statements, we're talking about income statement, your balance sheet, your statement of changes in equity, including its income statement, balance sheet, and the statement of changes in equity. At this point in time, you guys are not allowed to do the cash flow, right? But however, you are allowed to do the notes. Okay. So starting with our learning unit 1, and we're looking at the basic concepts with the principles and the objectives in regards to the accounting. So our basic concept and principles and the objectives of accounting here, we're explaining the functions and the objectives of the accounting, and then why is it needed to do the financial information, and how is it communicated. Okay, so that's quite easy. Each and every firm, they need an accounting and a bookkeeper or a CA, so that we can keep track of our financials. We need to know, or we need to record every transaction or every movement that happens within our firm. That's the main concept of the principles and the objectives. However, we still need to comply with the accounting language. What is accounting? So you need to go to your definition in your study guide there. And then we also look at our B, which is looking at the nature of the accounting, right? Which is a specialized means, the way of communicating in regards to the entity's finance. All right. The nice part about accounting, and I always emphasize this on my classes each and every semester when I'm educated to do my job. We don't want you to be intelligent, but we want you to comply. And then why is it a compliance? The reason for the compliance is because we need to set out the standard, the formulation on how you're going to write your financial statements. That's why you need things like standards, or things like your standards or your IFRS. So they regulate the concepts or the transactions that they do happen in a firm. You cannot come up with your own methodology of doing the financial statements. You need to be in compliant. Right. So we have to use the words and figures as an accountant, and which are also known as the concepts, principles, and the procedures of accounting. So using the words is the language in terms of the commerce, and the figures, obviously, things like your depreciations and your rentals and stuff like that. Which one goes where in terms of our financial statements? I'm not sure. Guys, can you see what I'm showing on my screen? Can you see my page?
Yeah, we can. Learning Unit 1, basic concepts. Is that it? Yeah.
All right. Thank you very much for that. Let's look at the universal accounting denominator. And the common unit of the measurement in accounting is money. And in South Africa, we use the currency. They normally call it the rand reserve. This is how it works. So each and every county, they've got their own currency that they use. All right. So if, let's say, for example, you've got a firm in South Africa, and then you've got a firm in Algeria, for example, their currency is a dinar. All right. So it means that when you prepare the financial statements, there should be a conversion. However, in Algeria, they're going to prepare their financial statement with their currency, which is a dinar. Because if you use the rand and the dinar the same time, it's going to cause a confusion, because those two currencies are actually not equally the same. Right. So I hope we are clear on that. Let's look at the important limitation in utilizing our money. Not all the events are actually expressed in terms of their monetary terms. Like I said before, we've got words and we've got figures that we have to use in the accounting. The value of money is unstable and is influenced by the major economic factors such as the inflation. If you can look at what happened in our country or in our economy, we had so many things in terms of the stability of the prices. Most of the prices, they went up, some of the prices, they went up. Or if you can look at the issue of like a petrol, it's quite unstable in a short space of time, because sometimes it goes up, sometimes it goes down due to economic factors, and mostly are such as the inflation. For example, we're much dependent on the Russia and the Ukraine with regards to oil. All right. So if the demand is high, obviously the price factor in regards to the price of the petrol will actually change. If the demand is low, obviously it will be influenced by that price factor. We've seen that when we were deeply under the COVID, where there was no movement in our country. So the demand in regards to the petrol has gone down. But the food prices, everybody was actually looking at buying the food and all of those, even though it's something that is actually needed on a daily basis within our household. Right, 1.4 entails the forms of ownership, and then we've got four main types of one, which is your sole trader, rather. So I've highlighted that with red as a major focus, and simply because you guys are dealing with a sole trader in this content. Partnership, not at a stage, but it's part of our forms of ownership. And the CC, which is a closed corporation, not yet as well. And then you're going to have what's called the companies. I think those that will be measuring in accounting and auditing, you will see that when you do your second year, third year, and fourth year, then you'll be able to actually move from sole trader and do your partnership. Partnership, I think you'll do it when you do 1601. And then the CC, probably I'm not quite sure, but companies, just a little bit, and you'll see that mostly when you do your second year. Apart from this four, we've got the NPO that will be distinguished or discussed in topic E. That's actually our last topic. We'll deal with that. It is part of our content. The users of the financial information, investors. So usually when you start your company, for example, whether it's you or you've got investors, the providers of our capital, they need to know how much and where they invest in their money. So the legacy would be there, right? So every investor will be requiring you to actually provide them with your financial information. Otherwise, you need to convince them, to tell them that, you know what, my business is actually going to make profit because of this and this, my research and all of those. I've got a team of people that are actually working hard on this one, even though it's not easy, because people want to see proof that your net profit after you pay SARS, it required a good net asset value or an equity. So I think it was trending recently with news with regards to Elon Musk, who bought some equity at Twitter, spent a lot of money on that one to get some stake on that one. They're more concerned about with the risk in association with the investments and the return. Nobody wants to invest without getting a return, unless if you are investing in an NPO or an NGO. But we know that most of the firms, they do that simply because they just want to pay less tax. Staff members, they're more interested in their paychecks. That's why you give them schedules and then you pay them on a monthly basis. So those people are interested in the surety of the firm to pay their wages plus their salaries. My apologies for the bad writing there. There's stability in the profitability of the organization. Here's what happened. Most of the people lost their job during the COVID. You understand? Because nobody knew that we're going to have that kind of a pandemic. We didn't know how much is it going to influence us badly. But at the end of the day, it was the issue of staff cut. And most of us, we did lose our jobs. We had to find a way of getting another jobs and stuff like that so that we can survive. Lenders or the financial institutions, we're talking about their financial institutions, that includes your banks like ABSA, your Capitec, and all of those, including your own mutuals and stuff like that. They cannot give you money if they're not certain that you will be able to repay them back. It's easy to understand this one simply because imagine if you go to the bank and you're looking for a loan and you're not working. Which bank will be able to give you the money? That's the reason why they would need 3 months bank statement along with your current salary advance, right? So they care about the repayment of their loan simply because of they are in business. Let's look at the suppliers and the other trade creditors. The interest will be the same in those ones, so that there will be, for example, if you go to, let's say, ShopRite or Pick and Pay and all, those are big brands and the Woolworths. Whoever that is actually supplying that, they know that they've been in the industry for quite a long time. They made research with regards to their financial statements. They know that they won't be able to repay them back. Pretty much it's actually not that easy for everybody else. Okay, so it's the same as if you go to a store and then you open a clothing account. Obviously, they will be able to approve you based on how will you be able to make the payment. Right, customers, people like you and I. So this customer care about the existence of the organization and its reputations. For example, not everybody's actually interested in working at a brother place, right? Or not everybody's actually interested in buying goods that has expired, right? Or that has been tarnished before. Okay, so we've seen that with the KPMG in South Africa, they had to move out due to their own scandals in here because clients cannot associate, we're talking about big clients here, they cannot associate them with those kind of tarnished firms. Government and agencies, they're more interested in the allocations of resources in the activities of the company. So the same applies with the customers and the government agencies. They actually want to link themselves with people. But looking at the public, so the employment status of the company, how have you been employing people? Going forward, how will you be able to actually employ people? Right. Let's look at the fields of accounting. So when we do topic 1 here is that most of the things will just actually repeat itself. So it's advisable for you to actually can go read through that. And I think on in this topic or in topic B, we'll be able to deal with the issue of the debit and the credit, the issue of the BAE along with your double entry system, but we'll deal with that one at a later stage. Financial accounting, in this field, we're concerned about the recording of transactions and the preparations of the financial statement of the entire entities in compliance with the regulatory standards or regulations. I told you about the International Accounting Standard before, and here we are now, along with your IFRS. So when you prepare your financial statements, apparently these are the accounting standard at this point that you are going to be in compliance with. However, when you see big firms, let's say for example, UNISA, it's quite big, you understand? They can have more than 30,000 students in a semester, and This is the institutions, big institutions, actually, they've got different accounting cycles. You understand? We don't have one employee that is set up to do the data section, the account, the salary sections, the creator sections. So they've got a whole cycle that are independent of each other, and they're going to be responsible for that function. And it's simply because it's a big family, right? So, but small firms are actually different to that one. They can just say, okay, we don't deal with a lot of things. You have to be responsible for the data, the bank reconciliations, and all of those, simply because of they are small, right? So what I'm trying to establish here is we've got a starting point in regards to the accounting cycle. Transactions has to be established. We need to have somebody who's actually initiating the the source documents, and you'll do the bank recon, you'll do the cash receipts, you'll do the cash payments, and all of those. And then at the end of the day, there's going to be an accountant who's appointed to prepare the financial statements based on those kind of basics from the time it was initiated from the beginning. Management accounting. I always tell people that, you know what, if you are a financial accountant, most of the people that are intelligent in this world is the management accountant. These are the decision makers of the entities for specific projects. They have to analyze, they have to do forecasting, they have to do predictions. If the project fails, then we look mostly at them. Accounting policies, as I have actually explained that, we're looking at the conceptuals and the theoretical ideas. So here, there are no chances. That's where you apply your standards. Okay. And those of you that will be doing the accounting in 38 towards your postgrad, we're no longer going to be looking at the financial statements. We'll give you the financial statements to interpret and analyze that in compliance with the standards. Policies, we're looking at the guidelines to actually manage transactions, and the disclosure in the accounting policies. That's where you disclose your financial statements, again, in compliance with the accounting policies. But we've got the International Financial Reporting Standards. I think South Africa at this point in time, we don't have that. I think it's people that are based in Switzerland, if I'm not mistaken, your FS as well as your International Accounting Standards. So we have to adopt them from there. Right, so that looks at the accounting reporting that should be prepared in accordance with the above standards. Right, looking at the standards and the statements, let's look at how the objective of the accounting standard, which is to limit the variety of available accounting practice. On the conceptual framework for the financial reporting, there are going to be frameworks that we have to comply or standardize our statements of financial statements with. There's a certain way of doing your income statement, for example. So you cannot do the income statement by putting your expenses first. We all know with regards to the framework, it has to be your sales, and then you minus your cost of sales. That's where you get your gross profit, and then you get your other incomes, and then you put those and make the necessary adjustments if there are. And then obviously you put your expenses, and then you look at things like your finance cost, and then you get your net profit. Okay. At this point in time, you don't have to worry about tax as much as we know it's actually 28%. You should worry about that when you do your second year or your third year. Same applies to your accounting policies notes. You know, you're going to create columns with regards to your asset types, and then you calculate your movement. The same would apply with your statement of changes in equity, and the same principle would apply when you do your balance sheet. All right? I think you'll see that, or you will understand that when we do the practical part about it. Well, that's your conceptual framework for the financial reporting. All right, just want to finish up this one, and then before I move to learning unit 2, then I'll be able to, I can open up for questions for you guys. Just a moment. Okay, cool. Let's look at the underlying assumptions, which is your going concern. We'd be more concerned about, is your entity going to go forward? Is there going to be a progress with regards to your entity? Or is it going to liquidate? Those are the foreseeable possibilities that we are actually going to assess, which it is assumed that an entity will continue to trade or do business for a brighter future, and then it will allow your cost and revenue to be allocated to future accounting periods, and it will provide a more realistic value of the entity's assets. It will allow your fixed assets to be written off proportionally over their useful life. We know that our fixed assets contribute to your equipment, your rental building, your vehicle, so forth and so forth. Right, so we all know that as and when they are used, they depreciate. Okay, so this is more related to what happened during our COVID. We all know that most of the companies, they have collapsed. There was no going concern future in that kind of firms. Right, looking at the characteristics of the financial statements, the basics, which are the fundamentals. We're looking at the issue of, are they relevant? So this financial statement they have to be useful to the users, or the information included must be relevant. We're talking about, or I'm taking you a little back with regards to your investors. They care more about your financial statements. So the relevancy would look at or feature things like, did the transaction that you have recorded under your income statement or your balance sheet, did they feature in the current accounting cycle, which is our 12 months period? Okay, so what they're trying to say is, there's no way you can have a transaction that happened in 2019 and you put it in the financial year. Right. So the relevant information plays both the forecasting role and the also predictable role, as well as they are confirming that can as well be used to confirm to what extent the previous forecast has materialized. Right. So in this kind of an instant, we're looking at how much of the profit have we made the last semester, the last accounting period, how much of the assets do we have currently. Okay, and we have the materiality, which is an entity-specific aspect of the relevance. Sorry, I do hear you. I'm gonna take your questions as soon as I'm done with this learning unit. Right, let's have a faithful presentations. Transactions and other events must be presented faithfully. There must be an honesty in terms of the goodwill. Right, so we're going to look at the further enhancement in regards to the qualitative characteristics of the financial information. Comparability. Can you compare what happened previously to what is actually happening currently now? So the information included or disclosed in the financial statement should be compared by users over time to identify the trends within the components of the financial statements. Right. Are they in compliance or guided by your accounting policy? It's a question of a yes or no. Should there be any changes to what's the disclosed in the preparation? Should there be any changes must be disclosed to what's in the preparation of the financial statements? I'm going to give you an example with regards to that. For example, let's say under your notes, you have been using the depreciation on a straight line method. And then somehow you realize that, no, I just have to use the reducing balance method or the diminishing balance. You have to disclose that when you do your notes, right? Obviously, it will come up with the reasons as to why you're doing that. Are they verifiable? So the difference professional or analysts present, so observers should come to the same conclusion in regards to the presentation of it, no matter how you prepare your financial statements, but they should be verifiable by each and everyone who is actually consuming that or seeing that, right? So your financial statements should be verifiable. Are they within the time? That's where we're looking at the timeliness, and the financial statement should be made on time, as when it is required, and they should still be reliable. Are they understandable? Looking at the understandability here. Financial statement must always be understandable for the users. These people, they do not want to be confused. Right, let's look at the constraints on relevant and reliable information. Cost plays a major factor of constraints to the quality of the financial information. The benefits should be positive to exceed the cost in providing it. So we're looking at the cost of sales, which is not great for any operations, and the vice versa. So basically what they're saying here is, if you look at the revenue and the cost of sales part there, for example, if you do your financial statements and the cost of sales are always greater than your sales, then you might as well stop continuing for, because it's actually not benefiting anybody. your company will be in a lot of debts. You won't be able to pay your suppliers. You won't be able to pay your salaries. So a closure in this regards, it's actually potential for the firm, or it might be something that we are actually looking at. But elements of the financial statements, they're measured in the statement of financial position. That's your balance sheet. But things have changed now. Your headlines in terms of the financial statements, we used to have income statement previously. Now they've got something like statement of comprehensive income and the statement of profit and loss and other comprehensive income. That's your statement. That's your income statement. So the balance sheet has been changed to the statement of financial position. Right? Let's look at some elements measured in the statement of financial position. We've got your assets, we've got your equity, we've got your liability. That's how your framework is going to be structured. Right. Your asset will be comprised or composed of your non-current assets, and then you're going to have your current assets. We know that the non-current assets, they last for a period of more than 12 years, and the current assets, they last in less than 12 months period. Equity, that's where the stakeholders will be actually looking at the shareholders, and the liabilities, obviously, you're going to look at the unsustainable of your firms, right? Things like your long-term loan or short-term loan, overdrafts, and all of those. Your creditors, they will fall under the liabilities. And we also have a consistency of the non-current liabilities along with your current liabilities. So the same principle would actually apply. Statement of changes in equity. So at this point in time, because you guys are dealing with the sole traders, so when you do that, you're going to have what's called the capital. That's how much you have contributed when you start the business. Some, they bring their knowledge as part of their contributions. Some, they bring their assets, and some, they bring their money, and you start your business. Additional contribution. If you feel like the capital you contributed initially is actually not enough, then you would add more if the pocket actually sized up to give you the power that you can. Profit and loss. Obviously, you'll prepare your statement of profit and loss, and then the loss is going to be bracketed. And then if you've got a net profit, it will be transferred under your statement of changes in equity, but it will be out of the brackets. Drawings, mostly is for the personal use. So we know that when you run a spaza shop, for example, you would take maybe part of your stock to consume at home. So that will be drawings. And this is how you're going to see your drawings if you're required to do the statement of changes in equity. If any transaction is actually presented to you and state that it has been withdrawn for personal use, that means automatically there should be a drawings. So it will be, sorry, I didn't put that in the brackets, but it should be under the brackets. Why is it under brackets? Because it's decreasing your equity. Remember, you taking that as part of your stock. Please know that the contribution could be in a form of the knowledge. I mentioned that asset in the monetary value. If the asset defines the contribution type as a factor than money, the market value shall be attached to the components contributed. So what they're saying here in regards to the contribution of an asset, it means that we need to look at how much is the market value at the time you are contributing towards the company. Right, elements in the profit and loss, we're looking at the incomes and expenses as I gave you the profits. So if your incomes are greater than your expenses, that means you've got a profit. And then if your incomes are less than your expenses, that means you've got a loss. Okay. Right, 1.16, we're looking at the recognition of the elements of the financial statements. This is the nice part when you are actually dealing with second year. I'm talking about people that will be majoring with accounting. So it's important to get yourself used to the ways of the recognition, because you will be required to actually measure the recognition criteria when you analyze some of your assets or some of your incomes or some of your liabilities. Right? They're going to look at the definition of it and the recognition. I think I did that on my third year, but it was quite interesting when I was doing my financial accounting on my third year. Okay. So it's important to actually know this theory now so that it will build up you towards your future. Let's look at the probability of the future economic benefits, which it refers to the economic benefits associated with the flow to and from the entity. We know that asset actually has more value within the statement of financial position along with your liabilities, right? So when you've got an income towards the business, that's an inflow within the business. But when you're expending, it means that the money is actually going out of the business. So that actually defines the movement in regards to what comes in the business and what goes out. So my examples there stated that if there's a probability that we cannot manage to pay the creditor, then we must raise a liability in our books as part of the recognition criteria. How do we measure that in terms of our reliability? Measurements shall be possessed by cost, stroke value that can be measured reliably prior to its recognition, and if the reasonable estimate cannot be made, the item must not be disclosed in the statement of financial, in the financial statement components, but in the note. Okay, it means that it doesn't fit to be under financial statement, but it should be part of your notes, just as part of the disclosure under the notes. Right, so the item that possesses the qualitative characteristics of an element but fails to meet the criteria should only be disclosed in the notes as well. It's not a big deal. We'll see that when we do the practical part of that. Measurement of the elements of the financial statement, the process of determining the amounts to be disclosed for each time in the financial statement. There are several ways in which the amount can be determined under the historical cost. The actual amount can be paid in cash for a particular asset. And the current cost, that would include an amount an entity would have to pay currently to acquire the same type of an asset for carrying on the normal business. Reliable, I think that will include the reliable and the settlement value, but we did that. Okay, with an amount of cash that will be received currently if the asset has been disposed. For example, it is paid without interest. The present value of an asset, how much does it worth for the discontinuation to generate the cash inflow of the business? Right, and then we have a discontinued value, the present value of the amount at a specific rate of an interest over a specific period to an end of the value. For example, if you're buying an asset, obviously on an HP, right? So you're going to see as to how much does it worth, what are they inclusive in terms of the elements in there. So we're looking at the interest rate that are actually charged, how much of the term do we have? Is it 54 months, 72 months, and all of those. So most of you who've bought an asset that you bought via the bank, usually they will tell you this is the cash price, and this is the interest that is going to be charged, and this is the rate that we're going to include in there. Those other elements that are actually included in the cost. And you're going to look at, does it have the residual value? Does it have the balloon? Does my residual value include VAT? Does it not include VAT? Obviously, that will be your balloon. Historical cost basis is the most common basis for the measurement of the asset and the liability. There we're looking at the historical cost of measuring what an asset and the liabilities are. But let me get back to you. I just want to see if there are questions. Please raise your hands if you do have a question. Ashley Gavenda, Tandile, Buipelo.
Oh, no,
Taylor.
my hand was up earlier for one of your other questions. So no, I don't have any. Sorry.
Oh, you don't have any?
No, not me now.
Okay. You can't be so many. You can't be so many online and you don't have any questions. It means that you do understand it. Okay, guys, I'm begging you, please. This is how accounting works. Before you can be forward with your transactions, the basic way of doing that is you need to understand theory. Okay, please put yourself on mute. I'm not sure it's actually unmuted. I can hear the noise at your background. All right, let me tell you why am I saying that. It's easy. It's gonna cut up with you later. Believe me, I remember when I was doing my CTA, I struggled a lot simply because I couldn't analyze the theoretical parts to establish my own concept or principles, especially for those who will be measuring with accounting. If you're gonna do your honors in accounting or honors in tax or CTA and all of those, please, this is the time now. Make sure that you do understand your theory. You will be forced not to do financial statements anymore, but you will be forced to apply your consistent theory. And it starts there. Right. For auditing as well, external or internal, remember you'll be auditing the financial statements. You need to know them. Right, learning unit 2, we're looking at the financial statements. Oh, this time around, we're looking at one of the components of the financial statements, which is your financial position. That's actually your balance sheet. I'm going to open it quickly so that you will be able to see what am I talking about. Right, as I've mentioned that the learning unit 2 is all about the balance sheet. So your introduction will be as looking at the primary objective of accounting, which is to present the information in the financial statement and the financial results of the organization. So specifically, we're looking at the balance sheet. We all know that the balance sheet comprises of your assets, your equity, and your liability. Right. Sometimes you can get your multiple choice questions. They will trick you and say, calculate how much is the net asset value. So the net asset value, it's your equity. Right. So in how you derive at that one, you take your assets and then you minus your liability. It will give you your net asset value. Those that they do have the structure, they're probably having a clear idea of what am I referring to. All right, moving on. Let's see. The accounting entity and their financial periods. Financial statement can be prepared annually, biannually, quarterly, or even on a monthly basis. So the investors are more interested in, they can say at any time that they do want their financial statements. Okay. But here's the thing, a timeline requires us to do a financial statement for 12 months period, not more than that. Okay, but it can be less. Right, depending on when you start and when you plan to actually end your financial period. So financial statement can be prepared in or for less than 12 months, usually for the internal use of management, for planning, and the central purpose. 12 months financial statements are usually for the internal or the external purposes. So the accountant can prepare the financial statements internally due to the request via the management, and obviously the financial statement for 12 months period, it can be within the internal or it can be within the external purposes. That's the shareholders or the new investors. Financial position, like I said, is a statement of financial position, which is a balance sheet. This is often reflected in terms of 3 elements, as I said, in terms of basic accounting equation. Hence why I said BAE. So which are your assets, the expenditures, the equities, along with your liabilities. I think I have explained that. Right, a little example there, you're going to phrase it in this way. The statement of financial position must have a name. For example, I used my name there as a firm, which is Pucci Limited. It must be as at, not for the period. So I gave you an example there, is the 31st of December 2020, meaning that when you phrase your statement of financial position, you're going to say statement of financial, okay, you write your name, the company name on top, underneath you write your statement of financial position as at the 31st of December 2020. Obviously, you'll be looking at which year are you supposed to be in compliance with. So the reporting must be indicated in terms of the currency. For example, in South Africa, we use the rand. So this is where we don't need a contradiction in terms of the currency for the other countries that they do use. Just to make things easier, you're going to translate that at how much of the dollar or the euro or the dinar is at that time. But looking at the statement of financial position shall be determined as and when. However, the statement of financial position must be drawn at the end of each financial period for internal and external use. Right. So the time frame here, it actually speaks about your beginning. You should always be careful, as usually they like to give you the end period, so you need to determine your date back so that you can get the beginning of the period. For example, if they gave you that the financial statement year-end period is the 31st of December 2022, you obviously know that your beginning period is the 1st of January 2022. And then some of the things are going to be easy. Some of the things are, of course, going to require your adjustments. And you're going to look at what has happened during that financial, during that financial period. But the statement of financial position does not form part of the double entry system, but the statement of the balances, right? Double entry system, it's one of the things that I would specifically prepare it for you because I don't want to confuse everybody at this point in time. As you can recall, quite just now, 5 minutes ago, I spoke about what's called the net asset value. Can you see that I mentioned that? Number one, it says your assets minus your liability is equal to the equity. So the equity, it can be the net asset value. Just playing around with the accounting terms. But looking at the statement of financial position, which reflect the financial position of an entity at a specific point in time as in compliance with your framework. You need your assets, which is your non-current asset and current assets. You need your liabilities, which comprises of your non-current liabilities and the current liabilities, and then you need your equity. But here's the thing that I want you to be careful of. I'm going to teach you on how to deal with an equity because you're going to deal with that. All right, so there's going to be a movement with regards to your income expense. That's your statement of profit and loss. And then whatever that you get there is your net loss or your net profit is going to be transferred to your statement of changes in equity. And then afterwards, you're going to transfer that as part of your equity, meaning that your equity under the statement of changes in equity at the end of the period is going to be moved towards your statement of financial position. So whether you like it or not, you need to be in love with each and every element of your financial statements because they work along each other. But looking at the incomes and expense, these are the elements that are found in the profit and loss and other OCI. I think I spoke about that, which reflect the financial performance for a particular point in time, which indicate the changes in equity over a particular period as a result of the profit and loss incurred during that period. And that's the reason why the profit and loss are transferred to the equity statements. This is exactly what I've just explained, right? But I'll actually draft a training in terms of you move from here to there, and then we do this and this and this in regards to the entire set of the financial statements. Then we're looking at the definition of an asset, which is a resource controlled by an entity as a result of past events and from which the future economic benefits are expected to flow to an entity. Right? That's actually your definition of an asset. I think at this point, maybe a multiple choice question can become, they give you different types of the definition in regards to your assets, and then you have to pick the right one. What we're looking at, the resource that can be controlled by an entity, and it does not have to be owned by an entity. It does not have to be physical. For example, you are going to deal with things like, I think we've got intangible assets that can generate the flow of money to the entity, for example, goodwill, right? Or the investments or the fixed assets. You cannot touch those kind of things. However, you will be able to know that. But if you've got a physical asset, you will be able to can see and touch that. We're talking about the equipment, we're talking about the vehicles and all of those. Right, but here's the thing that you guys need to be careful about when it comes to the issue of an asset. You got your BMW, which is a dealership, they've got a floor plan that is well planned and all of those. So remember, inventory is an asset that forms part of your income statement along with your balance sheet. But the inventory that is actually left at the end of the period, that's the one that actually goes through to your statement of financial position. But the inventory that is actually allowing us to read or to control the movement in terms of our sale, that cannot go through to your statement of financial position. That's your stock. Do not confuse the two, because that kind of an asset, pretty much as you can see and touch it, it is not your current assets. Is going to be part of your stock. Remember, the nature of the business is to buy and sell. Right. So meaning that we're not going to look at things like your depreciation in that one. All we have to look at is the movement of how much of the inventory do we have when we open and how much is left when we close. All right. But the asset itself that is owned by an entity, it is actually the one that's going to be under our non-current assets. So when you read that kind of questions there, you need to understand the nature or the type of the business that they are actually dealing with. Moving further, I feel we've got the classification in terms of the assets, the non-current assets, the definition. I gave you that before by writing. So these are the assets these are the assets with a useful life longer than 12 months periods. That according to my definition, because the key word is the useful life that is actually longer than 12 months period. They should not be acquired for the resale. I just give you an example now with regards to Mercedes-Benz on the dealer floor. Right, if they are required or acquired for sale, it means that it's an inventory. It's no longer forming part of the non-current assets. They are to be used in the organization, obviously for production process. Okay. Right, looking at the examples of the non-current assets, we've got the land, building, and we've got the furniture and equipment, vehicles, and financial assets, as well as the fixed deposits. I told you, some of the things you can see and touch them, some of the things you cannot see them, but you will be able to know. Right, the current assets, looking at the criteria, they are expected to be realized with an intention for sale or consumption in an entity's normal operating period. We're talking about the goods that are at the shop, the Pick and Pay or ShopRite or Woolworths, those are actually expected to be sold within a normal operating accounting cycle. And they held primarily for trading. That's your trading stock. So looking at the current assets there, we're looking at the inventories, trade and other receivables. We used to have a term called debtors, but it is now being changed to trade and other receivables. And then we've got bank, which is now called the cash and cash equivalents. Right, and that would include your petty cash as well. So we're moving on as part of your subcomponents with this, which is the liabilities. Looking at the definition, we're looking at the present obligations. You can wonder why did I highlight that? That entity arising from the past events, settlement of which is expected to result in an outflow from the entity's resources and embodying economic benefits. If you've got a creditor that you have to pay, it means that the money will move out of the business. That's an outflow of resources within an entity. But you are actually going to benefit that because it's an exchange of a transaction. They gave you something, but then you're paying them back as part of your returns. In recognition of a liability, there must be a present obligation, which is a duty or a responsibility to act or perform in a certain way, and the obligation may have arisen from the past events of the transaction to be recognized as a liability. But let's look at what happened in the past events. You went to ABSA as a company, they gave you whatever the loan. So it means that you're now going to be the debtor towards ABSA. However, ABSA is going to be your creditor. Right, so that's actually the past events. But let's look at the present event. The present events will be payments towards the liabilities that you have with the bank. That's how it's going to be. Immediately when you are given that amount of money, that's how it's going to be recognized as a liability. Simply because you read the terms and conditions and then you signed, right? Income tax payable, I just put it here but it's actually not part of the syllabus per se. But I just included that as part of the clause, which he says that the government or the municipalities and the tax payables to local government are examples of obligations that arises from the statutory and other authority regulations. Okay, the tax and rates on the municipalities, so call them the local municipalities, the rate and tax that are actually payables toward that. Do not confuse that with your income tax that is due to SARS. I think at this point in time it's about 28%. Looking at the categories of liabilities, which is what non-current liabilities, and then we're talking about long-term debts, which must be settled for a period after 12 months. Examples will be the long-term debts, your mortgage, along with your debentures. Current liabilities, we're looking at, these are the debts that must be settled within a short-term period, that's actually in a year or in less than a year period. So it is the liability is actually classified as current if it satisfies the following, meaning that if it doesn't satisfy one of those criteria, that's actually not a liability. It is expected to be settled or paid in the entity's normal operating period, which is usually a year or less. That's your current liabilities. It should be held primarily for the purpose of trade. it should be an intention for you to actually get that loan from whoever the bank it might be, or financial institution. And it should not have an unconditional right to defer. That's the settlement of the liability for at least 12 months period after the reporting date. So the examples are your creditors as well as your bank overdraft. So by the deferring, it means that it should actually not be continued in over the period that you and your creditor have agreed on. Okay. So we see that with people that are actually making the overdrafts over the ATMs. So usually, I think at the end of the month, they take it, or whatever the agreement that you have with them, 2 months, 3 months or so, and they take their money back, because there's a sense of an entitlement in regards to that. Equity, this is where the shareholders of the firms are more interested in. It says that it's a residual interest in the assets of an entity after deducting all its liabilities, and it also represents for the owners the net asset of an entity. Everybody is actually interested in that, as to how much of the equity do we have, how much are we going to share. You understand? We hear that on our current affairs news all the time, that so and so is the CEO of whatever the mining, old mutual and stuff like that. They get 130 million rand, but the staff are actually not getting enough money. So they're looking at a certain amount of interest, an increase. I think I heard that on the news during the week on Eyewitness News about the Sibanya mine or something, where the employees were just looking for an increase of about 1,000 rand, and the company would say, no, we can offer you 800 rand and 50 rand of your housing allowance. That's where the trade union would come into the picture in terms of that kind of a labor disparities. Right, let's have a look at the sources that in equity can be accumulated from. Capital contributions by the owner, which could form part of the cash assets and the knowledge into the power. We explained that. Net profit or loss, which are made during the year in conducting your business by the owners. Application of the BAE. BAE stands for the Basic Accounting Equation. Right, it says that you can run around in regards to your components of the financial statement. You know that your assets equal to your equity plus liabilities. So mathematically expression, you can just, if you are given, let's say for example, you are given the equity and the liabilities and they say determine their net asset value. So you're going to plus the 2. If you are given the asset and the equity, you're going to minus the 2. And then if you are given the asset and the liability, you're still going to actually minus the 2 in order for you to get to your equity. Right. But in a nutshell, it is actually called your residual interest. So double entry systems, I think we've got a basic to actually touch on. So there are always 2 sides of the transactions, and every transaction has an influence on 2 or more items of the transaction. Basically what it says is, in accounting, we cannot run a transaction in one leg. You will see that when we do topic E, there's a part where we deal with what's called the incomplete record. For example, let's say you're buying goods for cash. You understand? So the incomplete record will be the money has stepped out of the bank account, and then you're just only doing that kind of a transaction. But the bigger question will be, but for what? Because we need to account for that. The goods that you have to buy, it has to be aligned with how much has been taken out of the bank account. Am I making sense? Right, that brings us to the end of our learning unit 2. I'm going to bring you guys up to speed. Any questions? All right, we've got Christelle. Please go ahead. Christelle, you can go ahead, please.
I wanted to ask, I just did not understand why among the assets, we have water and electricity as an expense, and then we have water and electricity as an asset. I don't understand why. Just explain that.
All right, Christelle, my volume, I don't know whether it's your volume or it's mine, but I'm struggling to hear you. I just heard something like electricity, water and electricity.
Yes, the water and electricity, yes, the assets. One.
Okay, I'm not sure if anybody can hear what Crystal is saying. If you do hear somebody with a loud volume, can you clarify that for me? If you do hear what Crystal is saying.
Can you hear me?
I can hear you. I think, Crystal, there's something wrong with your network on your side.
Can you hear me now?
I can hear you now. I can hear you now.
Oh, okay. No, I see that was the issue. Sorry about that.
Okay, you can go ahead, my dear, please.
So I was asking, why is it that we have water and electricity as an expense? That's fine. But now when we have water and electricity deposit as an asset, what does that mean? Why?
Okay, in terms of the double entry system, I'm not sure if this would answer your question. However, in terms of the water and electricity as in your expense, which is the part you understand as part of the relevancy, but you don't understand why is it an asset.
The deposit, there's water and electricity deposit that appears to be an asset.
All right. I think you can also refer me to what kind of an equation, but in terms of my double entry system is if you pay by cash towards your water and electricity, it's going to affect your assets, and this is how it's going to affect your asset. You pay because the money is moving out of your bank account.
Yes.
That makes it an asset. Remember, you've got your water and electricity as part of your expenses. That's what you have paid for. But the bigger question is, where does that money come from? Isn't it coming from the bank?
It is.
And then what is a bank in terms of an accounting? It's a current assets, right?
Current assets, yes.
Which is why they are interlinking together. But I'm just giving you these in terms of the double entry system. I would like you to actually show me that kind of an asset. Sorry, that kind of a question, and then I can clarify it for you. So does everybody understand? Christelle is asking, why is the water and electricity forming part of an asset? My explanation to that one is, in compliance with your double entry system, how do you pay that? If you're paying that by cash, obviously there's going to be a movement of money out of your bank account. And then the bank in terms of accounting is defined as an asset and is a current asset. That's why there's an asset that is actually affected when you are making a payment.
Okay, but in terms, okay, the specific exercise I'm talking about was one whereby you needed to identify asset liabilities and equity among the different items. So that was actually water and electricity deposit. It wasn't an expense. That's the expense. It was just the entry was just water and electricity deposit. So when we were doing when we were classifying them in terms of the BAE equation, it appeared on the side of assets as water and electricity deposits.
Oh, I get you. You talk about where you've got the types of assets and the type of an expenses and the equities. So under the water and electricity is disclosed under the asset when you do that basic accounting equations.
Yes, and it was water and electricity deposit, not the expense, like the deposit.
Okay, no, that's fine. I think I have to look at that one because I don't have that example in me right now. Would you be comfortable by sending me that over the WhatsApp group so that everybody else will be able to see that? You can just screenshot that question and the solution, and then you put it on a WhatsApp.
All right.
Because it doesn't make sense to me on how it has been recorded, unless if it is an error. But I think as soon as I have a look at it, I will be able to tell you why did they do that.
Okay, I think it's even on the exercise relating to this specific unit on the study guide. Yeah, I think it's one of the e-tutor questions. I'll find it and I'll give it to you. And it came through an assessment, that question also. So we had to classify it as what. So I just did as per the exercise, but I don't quite understand why.
Okay, no, it's fine. Let's agree that you will just shoot that and then you will screenshot that on our WhatsApp, and then I will be able to and I will be able to discuss it on the WhatsApp because we don't have it right now. Does it make sense?
Yeah, thank you. Okay.
All right, thank you very much. Thank you so much for that question, Krista. Anybody with a question? Quickly. I've got Rwanda Vilagache. Please go ahead.
Hi. Could you please clarify your example on inventory? Where you made that example about BMWs and Mercedes Benz's, the dealership.
Would you like me to clarify that?
Yeah, there was a cut in the line, so I didn't catch the full example.
Okay. All right. Thank you so much, Rwanda. What you wanted to know is, remember what I was explaining the different type of an assets in terms of the current and the non-current asset. This question is basically based on what entails the current asset. All right. Here's the thing. I hope you do hear me one day. When you buy the car, you go to a certain dealer, and then the dealer, obviously, they would liaise with whatever the financial institution is. All right. So this is how I differentiate what's called the current assets and the non-current assets. What I'm saying is the cars that you see at the dealer on the floor plan, which are actually based on a normal trading transactions, that's actually regarded as a stock, meaning that it will be the part of that firm's inventory. Why am I saying that is because of they are used for trading purposes. They are not used for the production process. I don't know. I'm trying to say whatever. Okay, the goods that you see at Woolworths on the stock is the same thing as the cars that you see on the dealer floor plan that are actually used for trade purposes. However, the cars that are bought by Woolworths for their production processes, because they don't sell that to their clients, those are the cars that will be classified under your non-current assets.
Okay. No, I understand now. I understand now. Thank you. I understand. Thank you.
All right. Thank you so much. So, guys, you need to be very careful. Sometimes they would mention to say these kind of cars are actually for trading purposes, or they will say these cars are bought for the production process of the firm. That's where you have to. If it's actually for trading purposes, that's inventory. So it should go under your statement of statement of profit and loss and other comprehensive income initially, and then whatever that is actually left, it will go through under your balance sheet as your inventory that is left at the end of the financial period. Meaning that we're going to open with that in the next accounting period, up until it becomes to an end. Right. So it's actually the same as the retail stores. The retail stores, they are probably having a policy of doing what's called the daily recon, or they do what's called the weekly recon or the monthly recon. They're going to look at how much of the stock do we have currently, how much have we sold in this week, and then how much is left by the next week Monday. Meaning that that's going to be your opening inventory next week Monday. So if that's actually the stock that would last for 12 months period, you're going to look at how much have we had at the beginning of January, and then how much are we left with at the end of the period. Then that will be the opening inventory for the next accounting period. I think you will see that, or it will make sense when we deal with the practical questions. I'm not sure if Crystal want to come back. I see your hands up. Crystal, are you fine?
No, my hand is not up. Okay, let me lower it. Maybe I forgot to put it down.
Okay, please do me a favor. Yeah, it's actually removed. Any other questions before I move on to learning unit 3? Any other questions?
Sorry, so can I just establish then a non-current would be like a vehicle purchased for the company, and the one that you're selling, like you used the example for BMW, would be a current asset because it's for resale.
Yes, the one that is used for resale
inventory.
The one that is used for resale will be for the current assets. However, at the end of the financial period, it will only qualify for the current asset at the end of the period, because we have to determine as to how much of that kind of a vehicle for trading purpose is left in the company.
Okay, thanks.
Makes sense?
Yeah.
All right. Now you will see that. You will see that. A third part will be the financial performance. That's your income statement. Right, that's your learning unit 3. Right, the statement of profit and loss and other comprehensive, it provides information about financial performance of an entity for a specific period. Usually that will be for 12 months period. Okay, so if you can see here, I'm actually highlighted the financial performance. So every firm will be profit orientated as part of their self-driven. Well, same applies to you as a student. Your performance will be, you're interested in passing, right? I'm sure you'd agree with that. So that will be a good result for each and every student in there. Other than the pass, you just don't want to pass. You need to pass with an understanding. Okay, so the entity, when they do the income statement, they just need to understand that. That's why in one of the qualitative characteristics, they talk about the understandability. Right, so your financial performance is actually your income minus your expenses. That's how your framework will be will be structured in a way. So you'll see that. I think some of you might have seen on how it has been presented. Okay, so but basically there will be your sales minus your cost of sales, and then you get your other incomes, and then you get your expenses, the financial cost, and then you get your net profit or your net loss. Net loss in this instance for you as a student will be a fail, which is what you guys do not want. For 3.2, we're looking at the financial performance, the results. For you, it's a pass. For an entity, is a profit. If your incomes are actually greater than your expenses, and then if your expenses are greater than income, then you've got what's called the loss. Let's recognize our loss in here, or let's look at what our loss entails. We're looking at an increase in the economic benefit during the accounting period, which is 12 months, in the form of an inflow, the enhancement of an asset, or the decrease in the liabilities that results in an increase in equity, other than those relating to the contributions from the equity participants. Components are your revenues, which include your sales, and then you minus your sales returns, and obviously that will give you the net sales. And then you're going to look at your cost of sales feature. Let's look at the gains, which includes, that's your incomes, the fees and along with your sales, the interest and the rent incomes, the dividend, commission, and as well as the bad debts recovered. So we're no longer using that words for the bad debt. We use credit losses recovered. So even if you write the bad debt recovers, we're not going to penalize you for that, but we would encourage everybody to actually move along with us in the same way. Expenses, we're looking at the decrease in the economic benefit. Can you look at how the difference it is? In the incomes, we're looking at the increase in the economic benefit. In the expenses, we're looking at the decrease in the economic benefits during the accounting periods in the form of an outflow, the depletion of an asset. Depletion of an asset, they're looking at things like your depreciation, right, or the disposals. So if you dispose it at a loss, that will be an expense. And then if you dispose it at a profit, obviously you're going to get the gain. And there's a way of calculating that, but we'll see that when we cross that bridge. So in the currencies of the liabilities that results in the decrease in an equity, then those relating to the distribution to the equity participants. Examples of an expenses I gave you a few, which is insurance, depreciation, and the bank charges. So I think when we do our topic C, we'll look at things, if I'm not mistaken, things like your depreciation and hardship, because I know that gives a lot of students a bit of a trouble. But now I assume that in your calculations of the multiple choice questions, you would be given this kind of questions on how you have to calculate your depreciation. But we'll get there. Losses. These are the degrees in the economic benefit that do not rise from the normal activities of an entity. For example, the damage caused by a fire is a natural disaster, or the loss of the sale of a non-current asset. If it's no longer useful or viable for the company, the easiest way is to sell it. We've seen that happening in many companies where they would have assets that they will use it for production purposes and they sell it to their staff. That will be probably part of their first preferences, or they sell it back to whoever the dealer might be to actually continue with their trade. Let's look at how the profit and loss has been influenced as part of the equity. So the incomes of the property increase your equity and the loss decreases on your equity. That is your statement of changes in equity. I think I give you this kind of a mathematical expression where your equity will be your capital plus net profit, or it will be your capital minus your net loss. Statement of profit and loss and other incomes. So there will be your income statement performance. Statement of profit and loss and OCI list all the revenue and the expenses, and then you derive your net profit or loss for the period, and it must be shown under the name of the business and the period which it has been formed in, that has to be complied with. So as I gave you an example there with Pucci Limited. So this is how I'm going to show it. Statement of the profit and loss and other comprehensive for the year 31st December 2022. So it's important again to know your framework. Let's look at the movements, which attributes to your statement of your changes in equity. This statement of the movements determine what happens within the equity of the shareholders. So we're going to look at what does it contain. So your capital contributions by your owners, that's your capital. It can be in the form of cash assets or the number of assets, and the additional contributions by the owners. So you add, and then you get your net profit, you add. If you get your net loss, then it has to be deducted from your profit or loss. And then we're going to look at, you remember when I spoke to you about the draws, then you saw the withdrawal of the stock or the asset or the cash, that would form part of your deduction. Policies and explanatory notes, we deal with this. It's just a refresher for you. These are prepared to give the additional information on items appearing in the financial statements. Accounting policy note, it's important. So you just explain your FS compliance and guidelines in terms of the measurement, particularly they mostly include the depreciation method in use and other policies to be disclosed. Right, so it's important to tell us that the asset has been disclosed, or as the depreciation of an asset has been utilized by using whatever the type of the depreciation has been allocated to you, decided to use as a fact. So it can be a straight line, it can be a reducing balance method, or it can be the production units method. Like I said, we'll see that when we close the bridges. Additional information on items in the financial statements. This should disclose the source of the revenue, the carrying amount of the property, plant, and equipment. So this is how the notes is going to be very important. You're going to do your notes with the relevant columns and the relevant assets. The carrying amount at the end of the period, it's what it is going to be transferred under your balance sheet at the end of the financial period. Okay, so this is how short our statement of profit and loss is. And let me get back to you and give you the opportunity to give me questions. It's easy, right? Very easy. Incomes, expenses, asset, equities, and liabilities, frameworks, you just put them in there. Compliance with your guidelines, and the accounting policies. It's very easy, I suppose, especially if you got your notes in order. Right, lending unit 4 comprises the recording of their transactions. So our intro there, we need to understand on how the concept of the debit and credit work. Okay, so usually your debit is on the left and the credit is actually on the right. That's not important. The important is how do you go by that? Which one falls under debit and which of the transactions falls under the credit? Why? And then when you move the transaction toward the debit and the credit, there should be reasons why you are doing that. Basic accounting equation, like what Crystal did, it's important to understand these things. Right, let me read for you my double entry system. In order to comply with the double entry system, the following components will be complied with. Effect of the transactions, which affect on BAE, that's your basic accounting equation. And how is the transaction going to affect the financial statements of the entity? So it's the question of where do you start and then where do you end in compliance with regards to your BAE and in conjunction with your debit and credit. Identifying the components of the account to be affected, that will depend on what are the kinds of what are the kind of transactions are given to you. That would lead you to how you understand the effect of the debit and the credit along with your double entry system. But determining the account to be a debit and credit, that's very crucial in it. So we're going to deal with that most of the times as we go along. So the amount on the debit should always equal the amount on the credit side. Okay, so that's actually involving the balancing factor. So at the end of the day, your balance should be equal. So the transaction date is actually important. The folio number, it's actually in your subsidiary journals. We don't deal with that anymore, but you just need to know that as part of your basics. We did that in the high school and then we're done. We're moving on to the next stage. Name of the contra account, you should be able to know which accounts are actually affected. If you've got a bank, then what will be the contra account? The contra account will actually liaise or be compliant with your double interest system. So we're having the effect of the transactions in the basic accounting equation. It says that for every transaction, there will be an effect of the change in the financial statements of an entity, and therefore an effect will be in accordance with the basic accounting equations. So the effect will be you're buying this, and then when you're buying that, are you debiting that or are you creating that? How are you buying that? Is it by cash or is it by cash? Or is it a donation? That's how you're going to get the movement in terms of the recording or the effect of a change in terms of that specific transactions. So looking at the four ways in the different, so that the four ways in different ways in which the equation can change but remain in balance. By an increase on the left-hand side with a corresponding increase on the right-hand side. So still those are the types of accounts that are going to be affected. Right, we're going to, whether looking at the increase with an increase, and then we're going to look at the decrease along with the decrease. Or is there an increase with a decrease, but we'll see that when we do the practical questions. But pointer 3 will be the corresponding increase with a decrease on the left-hand side, and or the corresponding increase or decrease in the left-hand side. I think I did one and the same thing. I was trying to say right-hand side. Okay. So let's have a look at 4 and 4. 4.4, which says the transactions which affect only assets, equity, and liabilities. Capital contributions, with whether by knowledge or power, whether by asset, and whether by cash, and this will have a positive increase of the asset and a positive increase of the equity. So this kind of a summary is actually in your book. Please do not be lazy to read this and try to create your own practical example or follow the steps that are actually there. Acquisitions of a loan, there will be an increase in asset. So when you acquire a loan, the money will be in your bank account. That will increase your left leg. That's your asset, and it will increase your liabilities. What means that the upsell F&B is going to increase under your financial statement. Purchasing of an asset for cash, decrease on bank, and an increase on the asset itself. But you need to be very careful when it comes to the purchase of an asset. So if it has been purchased for credit, there's no bank involved in there, right? So the transaction should be affected there when the asset is actually purchased or bought on credit. It will be your creditors along with the question. So along with the asset in question that has been purchased. Right, and then when you pay your creditors, obviously that will be decreasing your creditors, and then your bank will also decrease because the money is actually stepping out of your business, and then obviously your creditors, the loan that you have with the creditors is coming down. Withdrawals, as I mentioned, is drawings by the owners for personal use. That will increase the personal benefit and decrease the equity. But remember, when you are taking the goods and the money out of the business, it's going to shift your profit by going down because the product that you took with the money that you took out of there, it's no longer going to increase your equity. All right, let's look at the transactions which give rise to an income and the expenditures. Income in the form of cash that will increase your bank account and decrease your inventory, as an example. If you want those notes, but I think they do post this class, so you can either you can refresh by listening to what I've explained, or you can just request this notes by an email. I'll send them through to you. That's fine. I'll give you my details at the end of the session, like I said. So expenditures in terms of the cash, it will decrease the bank account because the money will be stepping out of the bank, and decrease the expenditure because you are paying towards that kind of expenditure. Right, credit income decreases your inventory of services that has been rendered, and it increases your debtors along with your credit expenditures. So it's going to be the vice versa, with an increase in expenditure and an increase in expenditure. I think maybe I didn't do something right with credit expenditure. Okay, the expense will just go up and the liabilities will actually go up as well. But the bank won't be affected there because the expenditure is actually performed by credit. But when you receive payment from your debtors, remember you are going to be somebody's debtor and somebody's going to be your debtor at the same time. You can have asset banks which becomes positive because we are receiving the money, and the specific debtor in question will be forming part of your decrease because they are paying you. Right, and then let me have a look at the summary of transactions. The basic form of the statement of financial position. Now we bring in the statement of financial position into the picture. So every adjustment appeared on the basic account equation will be transferred to the statement of financial position and the statement of profit or loss and other comprehensive income. So that means that when you adjust whatever that you have performed as part of your transactions, is either is going to have an effect towards the statement of profit and loss or the statement of financial position. General ledger accounts, they're performed in a form of a T accounts. I hope you guys all know this T account where you do your, I think it's vertical and, what do you call it? Vertical and horizontal. And then you put the account transaction on top, and then you're actually going to deal with the movement of what happens into that ledger account. And then obviously you're going to transfer wherever, you're going to transfer the final stage of whatever that you did there in wherever it qualifies to be at. It also shows that side of the left in the credit, your T account will be the debit side and the credit side is part of the show, and will reflect the decrease and increase depending on the type of account you are actually dealing with. Okay. Asset accounts is an increase on the debit side and the decrease on the credit side. Okay, I'm going to give you that kind of analysis just now in terms of the assets and your equities and expenses in terms, I'll explain that. All right, but I think they are explained in here. By the standard, the policy, we know that the asset increase on the debit side and decrease on the credit side. And then the equity will increase on the credit side and decrease on the debit side. But like I said before, it includes things like your items like your capital drawings and profit loss, and the increase on the credit side. Liabilities increases on the credit side and decrease on the debit side. And the above amounts include accounts as non-current, which are land. I think I wanted to say bond, sorry. Long-term loan, the current, which are creditors, bank overdraft, and the others. But the income and expenditures, which we know is actually the statement of profit and loss and other comprehensive transactions. So it says that the income increases on the credit side and then it decreases on the debit side. And they also increase equity. They refer to the income, and the assets, sorry, the expenses decreases your equity. So the examples will be your rental received along with your revenue. That's actually forming part of your incomes. I think I gave you an example with regards to expenses. That was the depreciation and the bad debts as well as your insurances. But here we are at that kind of an explanation. Expenses, they're also increasing on the debit side and decrease on the credit side. And they decrease your equity. So the examples are rental paid along with your depreciation. Okay, I'll try to drop that kind of a segment as to that kind of a map to show you, because I know some of you still need that kind of a basic, and you'll be able to see that. So I'll be able to drop that on my web, and I'll show you that. I'll send it for me to you on Wednesday when we have that class. So you are balancing your accounts. So different accounts have different entries in terms of debit and credit, depending on the type of account that you are dealing with. So balancing the carrying down of any account type will eventually be the closing figure to become the balance brought down in the next financial period as an opening balance. All right, let's have a look at how you record your transactions in the ledger accounts, depending on which accounts you're dealing with. However, the principle of the double entry should still be applicable. So they say that depending on what kind of an accounts you are dealing with, So it's either you're dealing with the T account, the liabilities, the incomes, the expense, or the equities, along with your assets. So I think that's where you need to get the principles of which type of account increases where and decreases where. And obviously, some certain type of transactions under the additional information will have an effect as to whether it will go to the debit side or the credit side. But trial balance. So this consists of the list of all the balances of all the accounts in the general ledger of all the accounts in the date. So let's say you prepare a list of many T accounts that would include your assets, your liabilities, and your incomes. So your balance carried down will be the one to be transferred through to your balance, the trial balance. I think that will help you to prepare your financial statements as well. Okay, so under the trial balance, you're going to have what's called the debit and the credit side, and then you will be able to put some of the transactions under your debit side and some of the transactions under your credit side. So it will depend as to whether it's an asset, it's an equity, it's an income, or it's an expense. But it is compiled to test the arithmetic corrections of the entries. That's quite a mathematical expression, or the appreciation of the double entry systems. So it serves as the basics of the preparations of the financial statements components. So that's exactly what I just said. Now, after you prepare your trial balance, then you can do a set of your financial statements, depending on which of the debit goes to the statement of profit and loss or the statement of financial position. So it says that the following records may appear in the trial balance. Error and omission, transaction is omitted, either debit or credit entries have been recorded. They like this thing when you do your bank reconciliation statements. So whether you like it or not, whether you are actually in a live environment or you're doing your books as part of your studies. So the errors will be there that wants you to actually correct them. Okay, so you need to actually omit that error and do the right thing. It's like error on how you post to the posting of the wrong account. And this happens when an item is posted to the correct side of the ledger, but to the wrong account. For example, the insurance account being debited instead of the depreciation account. Let's say you are dealing with the T account for the insurance, but you put the transactions that belong to the depreciation account under the insurance account. And then this is how you go to deal with it. So the principle says that you need to correct the error in the initial account. In this case, it will be in the insurance account. And then after you correct that, you move it to the correct account, which is your depreciation. Okay. So if your insurance account allows you to be a zero, it's an error. You just correct the insurance account and then you transfer error adjustment of the figures to where it belongs. So in this instance, it will be the depreciation account. Then how you compensate your errors. So this is exactly what I just explained now. To balance the posting error on the side of the ledger accounts may coincidentally be compensated by the identical error on the other side of the ledger. So be careful when you do your bank reconciliation or when you do your debtors control account or the creditors control account. So normally they will give you the list of transactions that they do not belong there as part of your error. So you just need to omit that and post the error to where it belongs. The error of the principles. So that lays with the principles of recording your transactions that becomes faulty. For example, expense account with a credit opening. We all know that your assets and your expenses, they do have an opening balance on the debit side, meaning that they increase on the debit side and they decrease on the credit side. Errors which will be revealed by the trial balance, otherwise it won't be balancing because of those kind of errors. So some of the items, they will be recorded on the debit side, but they're supposed to be on the credit side. So the same principle would apply. Credit to be on the debit side as it is supposed to be. So the factors of the balancing a trial balance could lead to the following: the incorrect costing of the trial balance. Remember, when you do your balancing in terms of the debit and credit of your trial balance, so when you calculate the amount on the debit, they should match exactly what is actually on the credit side. With that being said, it means that your T accounts, one of the T accounts are calculated incorrectly. Or when you transfer the amount to the trial balance, it means that if it's supposed to go to the debit, you put it on the credit side. Then it means that you have to reverse that kind of an error. Right, so we're having the errors made in transforming to the ledger accounts, as I've spoken about the debit and the creditors control accounts in the form of the T accounts. Incorrect transactions in terms of the journal entries, that would include your cash receipts journal, your cash payments, your sales journal and purchases journals, along with your returns. Let's look at posting from and to different account might be incorrect. When you are unsure about your principles, that's when the debiting, which might be incorrect, can occur instead of the crediting. Right, 4.5.3, it looks at the trading error in the trial balance. So the errors in the trial balance should be performed on a timely basis just to make sure that things are actually done in order. Following the steps that should be taken into account, which is to work back what's, and if there's an error in between the debit and credit, the following procedure should be followed. So here what they say is when you're adding your figures on the debit side and they don't match your credit side, it means that you need to keep on adding them up together, because maybe it might be an error when you punch your calculator. However, if you're confident about your figures but they're still not matching, that means that the ledger accounts that you have to prepare, it means that there was an error back there. Unfortunately, you have to go back. So you cast each column of the trial balance again. That's how you actually add them together and see if they are actually corresponding. And then we ensure that all the balances in the general ledger has been transferred correctly and to the correct side of the trial balance. So you need to recheck your transfers from the journal to the ledger accounts and check the accuracy of the amount. Sometimes it's not because of you didn't know, it's just because of you have to be speed on time. Then obviously you do an error when you punch in your calculator, especially if you know your principles quite well. So look at the prep of the financial statements. So the trial balance serves as the basis for the preparations of the financial statements. That will help you as to which one goes to your statement of changes in equity, which one goes to your statement of profit and loss, and which one goes to the statement of financial position. Back again to the principles. I think I will just actually feature you with that one on Wednesday. So the components of the financial statements are as follows. I think we did this. P&L and OCI, that's your income and expense. And financial position it amounts to your assets, equity and liabilities. And the statement of changes in equity, we deal with your profit, capital, and loss and drawback. Statement of cash flow, it's actually not part of this content at this point. And then you do your notes. Right. So that brings us to the end of our learning unit 4. Right. My number is 067 859 3121. That's my WhatsApp number. I'm going to repeat again. It's 067 859 3121. All right, my email is paladimeso. It's PHALADIMESO @gmail.com.